Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to the other Home Depot. I had nothing else. It's Lowe's, ticker symbol LOW. First, we'll rate the strength of Lowe's business, including factors like industry and competition. 10 is invincible. A 1 is hopeless. Matt's at a 7. Jason, you're at an 8.
Yeah, it's an incredible growth story for Lowe's and Home Depot both, right? We kind of saw them grow in a lot of ways in tandem, even though Home Depot is the larger, more profitable business, and it's younger than Lowe's is. But I came in at an 8 because you get that confluence of the scale that it's built, the incredible operations, and still, I think, really strong tailwinds, even though the cycle is not great right now, keeps it really relevant and very profitable despite that cyclicality. And then, of course, the impact of the macro things that are affecting the business right now. Again, it's a business that's doing fine right now in a terrible environment. I think that says a lot about how strong it is as a retailer.
Yeah, and I gave it a 7. It's essentially part of a duopoly with Home Depot. That's not a bad description, the other Home Depot. And obviously that's its chief competitor. But the reason for a 7 for me was that Home Depot, in my opinion, does a better job in a lot of ways. They've done a better job of omni-channel. They've done a better job of getting like contractor business over the years. The industry does have several headwinds. Tariffs are one, high interest rates are another, which we'll get to a little bit later. And that's why I didn't rate it higher than a 7.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you have 8s, Jason.
Yeah, I'll leave talking about Marvin Ellison, the CEO, to Matt. He's done a wonderful job around the edges. I'll talk more about the board. He's the only executive director, the only employee that's also a director. And almost half of the independent directors' tenures actually precede his. And I think when you have a business that's done this well for this long, that says a lot about corporate culture when you start at the board. Also, most board members also own more than $3 million in Lowe's stock. These are all very wealthy people, but it represents a pretty sizable portion of their wealth, helping align shareholders. Ellison holds over $180 million worth. A lot of that he's been awarded over the years as part of his compensation, but he's holding on to it. Skin in the game is usually a good factor. Now, I'd like to see more metrics for compensation tied to per share things, but generally the focus of management's compensation is good. It's on things like operating income and inventory turnover, things that are really, really important for a retailer. So all of those things combined, I think, align management with shareholders, and it's resulted in really, really high quality management that's focused on doing things that work for the business and for people that own it.
Yeah, as Jason said, I'll talk a little bit about Marvin Ellison. He's got a really impressive resume, maybe other than that stretch as CEO of JCPenney.
Hey, somebody had to try to turn it around.
No one's perfect.
Everyone tried to turn it around.
Yeah, he's not the only one. Yeah, there was only so much he could do, but he was an executive at Home Depot, actually, during a particularly exciting growth period. He was in charge of their U.S. stores from right after the financial crisis through 2014. He's been with Lowe's as CEO since 2018. And since then, the stock's delivered 14% annualized returns for investors. So I can't make a case to give lower than an 8.
For financials, a 10 is a fortress, a 1 is yikes. Both of you have 8s, Jason.
Yeah, not only does it earn good margins for a retailer, but it turns inventory pretty well. And that's a really important way to drive earnings and cash flows when you're selling a lot of things that are lower margin. The balance sheet is very strong. Even though debt has grown, if you look at it in terms of leverage, it's really strong. The ongoing weak cycle in demand because of housing and the interest rate environment, they're impacting the business, but they're not hurting the business. And I think that says a lot about how strong the financials of the company are.
Yeah, I mean, they have about $3 billion in cash, a reasonable debt load for a business of that size. Revenue is down from 2022 and 2023. Mainly because of interest rate impacts and consumer confidence. That's a big part of my return thesis, so I'll talk about that in a minute. But this business does remain very profitable. An 8.3% net margin over the past 12 months might not sound that impressive for like a software company, but for a big box retailer, like look at Walmart's net margins. They would love an 8.3. There's no reason to think that that'll change anytime soon.
8.3% is massive for a retailer. Positive is sometimes massive for a retailer. Matt, let's talk valuation. How well will Lowe's stock do over the next 5 years? How safe is it? 10's a sure thing. 1's a lottery ticket.
See, I said 10 to 15%, and a lot of people might be surprised by that. I gave it an 8 for safety, which I don't think is a surprise. But I think the falling rate environment that's expected over the next, say, 2 or 3 years is going to be a lot more of a tailwind for these businesses than people think. Americans are sitting on more than home equity than ever before, about $35 trillion worth, but aren't really tapping into it right now because it costs a lot to do so. And I mean, Home Depot's CEO has even said people are delaying big projects because of high interest rates and they won't tap into their equity. So I think that's a massive opportunity that could, if the Fed actually starts cutting rates, will be a big tailwind. And if the economic environment cooperates for the next 5 years, total returns of 15% even are not out of the question.
Yeah, no, I think they're not out of the question. I think they're probably unlikely, though. Matt, I agreed with the safety score. I think this is a great ballast investment. The chances of investors losing money, I think, is extraordinarily low. Outperforming the market, I don't think that that's a really high likelihood either. Same range, 5 to 10%, probably the higher end of that range, because I do think everything you said about the economic environment and the cycle, plus likely some pent-up demand for home improvement projects and a lot of the things that Lowe sells and its pro customers, the services that they provide. I think there's a lot of pent-up demand for those things. But kind of how I get to the math is I think the valuation is high for the business where it is now. But it's not, that means it's not cheap, right? If you're going to buy it based on what it's going to do in 4 or 5 years, I don't think you're necessarily getting a cheap price. You're getting a reasonable price. So the floor is kind of that 2% dividend yield. They've grown the dividend over the past 5 years. So dividend growth should be part of your returns as well. Plus they bought back more than a quarter of shares outstanding over the same period. So and that's all happened during a weak part of the business cycle. So while the stock isn't cheap, and the business cycle turning could drive a lot of growth, I think dividend growth and the yield plus buying back shares and creating more per share value are probably going to provide about as much value as the growth of the business itself.
Let's move on to everyone's favorite topic. Matt, is there a company in Lowe space that you like better? And my apologies to retailers. Many of them are profitable. It's just the future sometimes is a little cloudy on that profitability. Go ahead, Matt.
I mean, I slightly prefer Home Depot just because I think it's done a better job with omni-channel, and that's going to be really, really important going forward. But if we expand to adjacent industries, I like Trex, Trex. They sell the composite decking products through some of these big box home improvement retailers, and I think they'll have just as much of a tailwind from people doing big projects again.
Yeah, and as much as I'd like to go stay in retail and dip into something like TJX companies that I just think is just kind of the epitome of what an incredible discount retailer looks like. It's not cheap. So if I'm looking for value with those same wonderful tailwinds around housing, I'm going to look at Trex as well. And building on what Matt said, the things that I think are really interesting about Trex is that it's hyper cyclical. It just makes decking and decking related products. That's an expensive discretionary product, but once people's access to like the home equity starts to get unlocked and interest rates come down and financing becomes more attractive, those are the kind of things that people have been putting off that they're going to be ready to do. And Trex is doubling its capacity with a big manufacturing expansion down in Arkansas. And it's really compelling if you look at how that could unlock massive amounts of cash flows for this business over the next 5 years, starting from today's starting point.
Thank you to both Jason and Matt. They've given Lowe's a strong overall score of 7.6 out of 10. The returns outlook takes it down a bit. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Alexandria Real Estate Equities. Till then, Fool on.
So what exactly would you say you do here?